Welcome to Smart Money, a monthly series where I cover some of the best stocks with huge growth potential that you can currently buy out there on the stock market. I evaluate these companies on the basis of how good of a buy they currently are in terms of their price, how good their future outlook is, and what makes especially them such a great investment. All of this follows the premise of finding stocks and doing the fundamental research that you need to build a portfolio, which can create a significant net worth while preserving your wealth even in the worst of times. So make sure to stay until the end to get the full-on overview of each company. And if you liked the video, I'd appreciate it if you could smash the like button. Our first company of today is a stock which probably all of you bought from before or are an active customer of. Yet only very few people that I know actually own the stock, which I personally find a little weird. So let's start into this monthly video with a true banger of a company, and that is Amazon. Amazon is a company that I've been eyeing since the start of my investment journey. However, their rather high valuation has somewhat scared me away from actually buying the company, and I think that is the case for a lot of people. However, let me take that fear, as I personally think Amazon has a ton going for it this year and for years to come. Let's at first take a quick look at the numbers though. Amazon is currently valued at a rather high 1.54 trillion, making it one of the biggest publicly traded companies. This valuation, however, obviously does not come out of thin air and can to some extent be attributed to the company's 386 billion revenue in their last fiscal year. Last but not least, it is safe to say that although Amazon doesn't pay a dividend, the company rewards its shareholders quite handsomely with market gains, which for the past year in the Amazon case sat at about 84.27%. Now, first of all, let's start out with the most obvious case for Amazon, and that is their leading role in e-commerce. Amazon at this point of time owns roughly 50% of the US e-commerce market, as well as a major chunk of the global e-commerce market in general. As most of you can also think, the e-commerce market had a pretty good run this year, as most of the shopping across the globe was only able to take place online. However, even without the pandemic, e-commerce is growing, which by default pushes people into the hands of Amazon. But it has to be said that they aren't sleeping on this lead, as the company keeps on further improving their infrastructure and logistics to win one of the most notable selling points, which is fast shipping. This is mostly done through acquisitions, buying stakes in companies, or just partnering up with players like Rivian that are going to produce EV solutions for Amazon that may push the delivery costs down even further along the way. However, Amazon also is way more than just e-commerce, which is quite often overlooked. Their probably most noteworthy subsidiary is Amazon Web Services, which is one of the original cloud hosting providers. As of this year, they are also the leading provider in their segment in front of Microsoft Azure. However, it has to be said that although they have been losing market share a little bit, they still were able to grow just their AWS revenue by 30% year over year. This is not only insane growth for a quite high margin business, but it also allows Amazon to actually fund new ventures with the relatively high cash flow produced by just AWS. This cash flow can then be used for investments into businesses like, for example, Amazon Prime, which provides a huge library of TV shows, sports events, and also regular benefits when shopping at Amazon. What, however, has to be said is that although the service doesn't have the Disney Plus and Netflix numbers, it's still a worthy opponent that, like HBO Max, has cross-selling as its main objective. To somewhat conclude, Amazon is a great company that you these days really can't get around. They are involved in basically every sort of venture and are starting to attack their competitors heads on. Therefore, I have to say that I personally think their valuation will just keep on going up, making it really unwise not to buy the stock. Our second company of the day is one that I've been constantly talking about for probably the last 4 months. However, up to this day, I think the company is simply too good to pass up on, for which reason I'll again be naming them. The company which I'm talking about is JP Morgan. However, let's again have a quick look at the numbers before we get into the thesis behind it. JP Morgan is currently valued at about $471.5 billion, which is quite a significant sum and can to some extent be attributed to their revenue of about $119.5 billion in their most recent fiscal year. However, it has to be said that they also distribute their financial gains to their shareholders. At the time of recording this video, JP Morgan currently pays a dividend of about $3.60, which over the past 5 years has been growing at a rate of 15.92%. But let's get to the most interesting part of why there currently is such a strong case to be made for JP Morgan as the best banking stock. First of all, JP Morgan as a bank is pretty much involved in every segment of the market. May it be through their already well-established but still expandable wealth or asset management divisions that continues to pull in billions of dollars, their overseas operations, or just typical banking business in the US. All of this obviously accounts for a huge chunk of revenue, which is then used to fund new ventures and take their competitors pretty heads on. The best example of this is how they took on Square, which provides point-of-sale solutions for merchants. Obviously, this fintech player has a great solution, but not really big customer bases to steamroll the market. Well, JP Morgan has the customers to do so, and since this is something right up their alley, they simply invented a similar tech for their own business. And well, I have to say that considering the current economic state, it worked out pretty decently. If we now combine this with the fact that JP Morgan is also somewhat getting into crypto by giving loans to companies that own crypto or are looking to do so, we can see that the company is keeping up really well with recent trends and is adjusting in a great manner, which gives me personally a great outlook for the future of JP Morgan. Our last company of today is one that has recently been in the news quite a lot. It definitely had its fair share of scandals, government hearings, but also huge successes. I'm talking about the pioneer of social media, and that is Facebook. As per usual, before we jump into the actual reason of why Facebook stock is so great, let's have a quick look at the numbers. At the time of recording this video, Facebook is valued at about $774.7 billion US dollars, which to some extent can be attributed to their revenue of about $85.9 billion in their last fiscal year. While Facebook doesn't really reward its shareholders with a distribution, they still put a smile on their shareholders' face as the company managed to deliver a one-year market return of about 73.76%. However, let's get to the actual reason of why I think Facebook is such a great stock to own, even with their somewhat controversial past. First of all, Facebook is an absolute social media powerhouse, as the company manages to pull in about 3.3 billion monthly individual users. That's around 40% of the total world population that uses a platform tied to Facebook on a monthly basis. And although it has been the source of controversy, they also gather data on these individuals, which can then be later sold to advertisers that from there on out are able to generate personalized campaigns to a certain customer group with specific attributes. You'd be wondering how well it works, and in all honesty, I personally would have to say that Facebook is sitting on digital gold. However, although one would think Facebook already is rather mature, I would have to state the exact opposite. A lot of companies are just starting to understand the true benefit of this kind of data, resulting in them wanting a piece of this highly profitable and rather cheap advertising data, on which Facebook obviously capitalizes as they are using a bidding system. Meaning, the more people that are looking to advertise, the more Facebook's revenue will grow without any big margin changes. And that is also the case we were able to observe in the most recent financial filing, which revealed a 33% year-over-year revenue growth. But it keeps on getting better, as Facebook as of yet isn't even monetizing all of its platforms. Take a look at, for example, WhatsApp, one of the biggest social media platforms across the globe with round about 2 billion users. If you would just monetize a tiny portion of that, trust me, Facebook's revenue would board a spaceship to the moon. What, however, is to be kept in mind is the privacy drama around Facebook and their data usage. If the company should face regulations, this could mean a significant damage to not only their reputation and brand, but also to their revenues.